Hello everyone. Today I will explain to you about chapter 16, control accounts. What is the purpose of control account? Purpose of control account is number 1 to locate errors, in the sales ledger and purchases ledger. What is sales ledger? Sales ledger representing trade receivables, and purchases ledger representing trade payables. So basically, control account is made to check whether our sales ledger and purchases ledger are correctly recorded. Yeah? And then next is to assist in locating errors when trial balance fails to balance or fails to agree or not equal. Yeah. And then number 3, to check arithmetical accuracy of the ledgers they control. So if you are preparing control accounts of a sales ledger, then it will controlling sales ledger. Yeah. If you are preparing control accounts of purchases ledger, then you are controlling purchase ledger. It depends on the control accounts that you prepare. Yeah. Number 4, to provide summary of transactions between debtors and creditors for each financial period. Debtors and creditors are also representing TR and TP. It's just different name, different terms. Yeah. Okay, that's the purpose of control account. Next one is identifying books of prime entry as the source. Books of prime entry as the source of informations of preparing control accounts. Okay. Now, number 1, in controlling sales ledger, or when we are preparing sales ledger control accounts, items inside sales ledger control account, there are 1, 2, 3, 4, 5, 6, 7, 8. There are 8 of them, yeah, and each of them are taken from books of prime entry. So first of all, sales. It comes from sales journal. Sales journal is representing sales on credit. So sales here is sales on credit. Yeah, not on cash, yeah, but on credit. And then sales return from sales return journal. And then cash bank receipt from debtors from cash book. Discount allowed from cash book. Dishonor checks from cash book. And refund to debtors from cash book. Bad debts. Bad debts is affecting TR. We have learned this bad debts before in semester 1, yeah? And bad debts affecting TR to be decreased. And sales ledger control accounts is controlling TR, yeah, or checking TR. So bad debts, of course, affecting SLCA. And bad debts information coming from general journal. Interest charge on overdue accounts also taken from general journal. Overdue account means late payment. Yeah. So if customers paid the company late, sometimes there is an interest that is charged to them. So it will be you can find it in the general journal. Yeah. So that's SLCA, and those are informations that are included in the SLCA. Next is PLCA. PLCA representing purchases ledger control account. Purchases ledger is TR. TP, yeah? It's TP, trade payables. Okay? And items in the PLCA are purchases, purchases return, cash or bank paid to. If you are in PLCA, it is cash or bank paid to. If you are as LCA, it's received from. Yeah, money received from, but for PLCA, it's paid to. So we have 6 of them. Yeah, this discount received is one of them, and refund from creditors is also there, and interest charge on overdue accounts. Same, late payment. If the company paid the supplier late, then there will be interest, or there might be interest that is charged to the company. So purchases is taken from purchases journal, and purchases journal is also representing purchases on credit. So it also for credit, yeah, not on cash. Okay. And then purchases return taken from purchases return journal, cash bank paid to creditors taken from cash book, discount received also taken from cash book, refunds from creditors is also from cash book, and interest charge goes to coming from general journal. Yeah. Next, what are the factors that can make SLCA show a credit balance? Okay, so SLCA, since it is TR, so normal balance will be in debit side because it's an asset. Yeah, and TP, normal balance, will be in credit side because it's a liability. Okay, now there is a possibility, yeah, when TR has credit balance, there's a possibility of that, and this also have a possibility of TP having a debit balance. Okay, now um, this is called abnormality. Okay, so normal balance for TR is debit, but there's a possibility TR having a credit balance. TP, normal balance, is in credit side, but there's also a possibility that TP is having a balance in the debit side. Now, let's see here. What are the factors that can make SLCA show a credit balance? Since SLCA is an asset, if SLCA shows a credit balance, it then becomes a liability. How can TR become a liability? Yeah, how can TR become a liability? And the answer is, it might occur because of number 1, an overpayment by the debtors. If the debtors or trade receivables paid more than it's supposed to the company, so the company will have a liability to return the money back to debtors. Yeah, that is why your SLCA might have a credit balance. Yeah, sometimes it is not always, but it is sometimes. That is why it's called abnormality. Yeah, it's not normal, but it can happen. Yeah. Number 2, the debtors returning goods after paying the account. So the debtors paid full 100% of the payment, but then there is a return. So logically speaking, your debtors or trade receivables are paying more. Yeah, that's number 2. The debtors paying in advance for the goods. So they paid you in advance before you gave them the goods. It called overpayment, actually, not overpayment. It is paid in advance. Yeah. So paying in advance is also making the SLCA have a credit balance, because the company will then have a liability in the form of goods, not in the form of money. but in the form of goods. Yeah, it is still called a liability. Next, cash discount not being deducted before payment was made. So the trade receivables actually receiving a discount so that they actually have um, uh, the advantages of discount where they can pay less than it's supposed to, but then they paid full because they forgot to calculate the discount that they received. Yeah. So basically, we are receiving their money more than they supposed to pay us. Yeah. So it is also called an overpayment because they forgot to deducting cash discount from the payment. Yeah. So all of these transactions will create a liability. Yeah. A liability from the company to trade receivables. It is not normal. Yeah. Usually, trade receivables is the one who owed money to the business, but since this four transactions happens, so the company um, had a liability to the TR. Okay, that is why sometimes SLCA can show a credit balance. Okay, next, what are debit balances? Now, in terms of definition, yeah, what are debit balances and credit balances represent in the SLCA? It's easy. If the debit balance appear, it representing money owing by debtors to the business. Okay, so it's a normal, yeah, it's a normal situation where the R is owing money to the business. But if the credit balance happens, credit balance appear, it representing can be money, can be goods, or can be services owing to debtors by the business. Okay, so the business is now has liabilities to the debtors in terms of money or goods or services. Yeah, because of this situation happens. Okay, next. Now, as LCA normal balance in debit, now for TP normal balance is credit. Here, yeah. So what are the factors that can make the LCA show a debit balance? Now note that PLCA has a normal balance in credit, yeah? Okay, so same like as LCA, this might occur because of the following factors. Number one, an overpayment to the creditor, still an overpayment, yeah? Returning goods to creditors after paying the account. Paying the creditor in advance, same, yeah? And cash discount not being deducted from before payment was made. So basically, you are both reasons in SLC and PLC are the same. If it is showing an abnormality balance, okay, it's just how you explain it from whose point of view, okay? Depends on whose point of view, yeah? Check on the question. Okay, what are debit balances and credit balances represent in PLCA? Okay, so PLCA has a normal balance in credit. So let's see the credit side first. Yeah, credit balance representing money owing to creditors. Money owing to creditors by the business. Yeah. Meanwhile, the abnormality is debit balance. Debit balance represents money or goods or services that is owing by the creditors to the business. Okay, so let's see. Since PLCA is a liability, when PLCA in the debit balance, it means that TP is asset. How can trade payables is an asset? Because of this. Yeah, so it means TP is an asset, means instead of we owe money to TP, but then it is now TP owed money to us. Yeah, amount owing to the business. Yeah, so amount owing to the business by creditors can be in the form of money, can be in the form of goods or services. Yeah, okay, now next. As we know, informations that we are needed, yeah, in terms of preparing SLCA and PLCA is taken from books of prime entry. All of these are books of prime entry. Yeah. And then why does the information used over here, why does the information used to write up sales or purchases ledger control account is obtained from books of prime and not from sales or purchases ledger? Sales and purchases ledger is individual. Yeah, ledger. Yeah, there are three ledgers: general ledger, sales ledgers, and purchases ledger. Back to sec 3. Okay, back to sec 3. Remember our sec 3 topic about ledgers. Yeah, now sales ledger consists of TR account, meanwhile purchases ledger consists of TP account. Okay, and books of prime entry is the whole new level, new chapter about tables. Tables where you categorizing similar transactions into categories. Yeah, sales journal, purchases return journal, sales return journal. Yeah. Now the questions here: why does the information used to write up or preparing purchase ledger and sales ledger control account is taken from books of prime, not from the ledger? Yeah, and the answer is because control account acts as a tool to control the ledger it controls. Okay, so if you are preparing sales ledger control account, sales ledger control account, you are trying to control sales ledger. If you are preparing purchases ledger control account, you are controlling purchases ledger. So if you are controlling the ledger, you cannot take the information from the ledger. You have to take the information from other source. Yeah, so that the result, if there is a mistake, the result will be shown. If you're taking it from the ledger, there will not be any difference. Yeah, so it is difficult for you to control it. Yeah, that is why here the reason why the control account is taken from books of prime entry, because the control account acts as a tool to control the ledger it controls. So the information used cannot be obtained from the ledger that it controls. Yeah, it has to be taken from the books of prime entry. Yeah, that's the reason. Yeah, and then next. So there is a possibility where in a business you have a TR and a TP, but they are actually the same person. TR is the same person as your TP. Okay, when you have this case, you need to do set off or writing off both TR and TP. Yeah, for example, um, like this. This is TR and this is TP. Let's say your TR owed you money for $10,000. And then you owed money to TP for $8,000. Okay? And apparently TR and TP are the same person. Let's say this is Roy and this is also Roy. Yeah, the same person. So imagine that you are the business. Roy has to pay you 10,000, but you also have to pay Roy 8,000. Instead of Roy paying you 10,000 and then you paid back Roy 8,000, then we need to set off his account. Okay, instead of paying doubled like that, like not doubled, like two actions like that, yeah, it at the same person. So why not we setting off the account with the smaller amount. Okay, so setting off means you erase the smaller amount. The smaller amount is 8,000. So we will erase TP. We decrease it by 8,000. And then we also decrease TR Roy with the same amount, which is deducting with 8,000. So it is now 2,000. Now, instead of Roy paying you 10,000, why not? He just paid you 2,000 and then it all settled. Yeah, you don't have any more debts to Roy, and Roy has settled his account to you. Yeah, so that is why setting off the LCA and SLCA is necessary when you have this case. When you have a case where TR and TP are apparently to be the same person. Yeah, so by definition, what is the meaning by setting off SLCA and PLCA? It means that the business has both a debtor and a creditor that apparently to be the same person. Rather than each business sending the other to pay off the debts, they may agree to set off one account against each other. Yeah, the amount that is set off is the smallest amount between the two businesses. Okay, that's important to know. Yeah, the smallest amount. Okay, now next, last one, template for SLCA. To prepare SLCA, this is how it's going to look like. Okay, on the debit side, you will have a balance BD over here, normal balance, yeah, and then this is the abnormal balance. Okay, the one where there is the overpayment, yeah, or any other transactions that might affecting SLCA to have a credit balance. Okay, now always remember the abnormality balance over here is always small. Always small amount, yeah, because it is abnormal. There is no, logically speaking, in reality, there is not many of trade receivables that overpaying you. Yeah, so that is why when you compare between BD the normal amount and BD the abnormal amount, the abnormal amount or the credit side will be small, will be lesser, way lesser. Yeah, the difference is quite big. For example, in the debit side it has 10,000, maybe in the credit side only by 100, something like that. Yeah, so the difference is quite large. Okay, so you basically you can understand by seeing the question, and then you can see there are two balance and the balance has a big difference amount. Yeah, so you know that which one is the abnormal and which one is the normal one. Okay, now sales on credit goes in the debit side like so, and this honor check in the debit side. Refund to debtors will be in the debit side, interest charge in the debit side. Okay, sales return in the credit side, cash bank received from the debtors goes to the credit side, discount allowed credit side, bad debts credit side, and setting off SLCA PLCA is also credit side. Okay, now why? Sales on credit, why is it in the debit side? Dishonor check also, and interest charge also. Yeah, because sales on credit will increase in TR. Dishonor check means TR is canceling, or payment made by the debtors is cancelled by the bank. So since it is cancelled, so the balance of TR is appear again. That is why it is increased again. So dishonor check will definitely increasing SLCA, yeah. And then interest charge is also increasing trade receivables. If your trade receivables late to make payments to you, you charge them more. Means their amount owing to the business is increased. That is why interest charge is also in the debit side. Now, refund. Refund to debtors is not returns. Pay attention, yeah? This is not returns. Refund here is basically from here, from this side. If there is an overpayment will shown in the credit side. Yeah, when the overpayment is returned or refunded by the business, it will goes to the opposite side. Yeah, that is why when there is a refund to customers or TR, put it in the debit side. Okay, that's the clue, because refund is taken from an overpayment account. An overpayment account goes in the credit side. That is why when you refund it, move it to the opposite side. Yeah. Please do not make mistakes by putting refund as returns. Yeah, it is different. Yeah. And then goes to the credit side. Sales return, definitely return will decreasing TR, so it goes to the credit side. And payment from debtors is also decreasing TR, so it goes to the credit side. Discount allowed, also decreasing amount owing to the business or TR, so it goes to the credit side. And bad debts is also decreasing TR. Yeah, setting off is also decreasing TR. So all of them decreasing TR, so it goes to the credit side. Okay. Last step is to calculate balance CD. Now, there is a possibility that you will have two balances. Okay, remember, SLCA can have two balances. Yeah, can have two balances, debit and credit. So if you have an overpayment balance at the end of the period, then put the balance CD, if any, in the debit side. Yeah, over here. Meanwhile, if you have a normal balance of TR, then it goes to the credit side, because it must be carried down to the next accounting period to the opposite side. Yeah, so it looks like that. Okay, now note over here, cash sales, bad debts recovered, and provision for doubtful debts are not included, because cash sales are not affecting TR. Bad debts recovered also not affecting TR. And provision for doubtful debts are not affecting TR, because it's just an estimation. It is not yet becoming bad debts. Yeah. So students' common mistakes usually put provision and cash sales inside the SLCA. So you pay attention on that. Yeah. Be careful. Okay. Next, SL. After SLCA, then PLCA. PLCA stands for Purchase Ledger Control Account. And in the Purchase Ledger Control Account, we have two balances. Yeah. The balance normal will be in the credit side, and the abnormal will be in the debit side, because an overpayment. Yeah. Overpayment or forgotten to deduct the payment with the discounts and etc. Yeah. And then purchases on credit will be in the credit side, interest charge in the credit side, and refunds also in the credit side. Okay, now why since PLCA is TP and TP is liability, so if there is purchases on credit, TP will increase. That is why it goes in credit side. Interest charge is also in the credit side, because if your trade payables charge you with interest, it means amount owing to them is increasing. That is why liability more, increase more. So it goes to the credit side. Now refunds here, same like as LCA, it comes from the abnormal balance, which is in the debit side balance. Okay, if you have an overpayment to TP and they refund the money to you, then it goes to the opposite side of the balance PD. Okay, it is not returns. Remember, it is refunds. So read the word carefully. Okay. Next, purchases return debit, cash blank paid to creditors debit, discount received debit, and setting off LCA, PLCA also debit. So all of these four are decreasing PLCA or decreasing TP. Of course, purchase return decreasing TP. Payment to creditors or TP is also decreasing TP. Discount received also decreasing TP. And setting off SLCA and PLCA is also decreasing TP. Okay, and then same with SLCA, you have to calculate balance CD. Balance CD normal will be in the debit side, and balance CD for overpayment will be in the credit side or abnormal. So next, carry it down to the next accounting period, and it will look like that. Okay, note, for PLCA, cash purchases is not included. Okay, so cash purchases is not included. Students' common mistakes, they put cash purchases inside. Cash purchases are not affecting TP because cash purchases is affecting cash or bank. Same goes to cash sales. Cash sales affecting cash and bank directly increase. It is not affecting TR at all. There is no amount owing to whoever it is. So that's it. That's the end of chapter 16 about control account. I hope you understand this video well. If you do not understand, you can always rewatch it again. And okay, I think that's it. Thank you very much for watching, and see you again for my next video. Bye bye.